So good morning, everybody. Welcome to another STC webinar, this time all around funding and hosted by Foresight. Should be a very interesting session today. Very much looking forward to this. My name is Pim van Baarsen. I'm CEO of the Silverstone Technology Cluster. As you might be aware, we do these webinars as an entire series. We've done quite a few of these so far. If you go to our YouTube page, you will see all the recordings of previous events. So do please check them out. There's a lot of valuable information there and good stuff. And we also have an upcoming events list on our website. So do please check that out and obviously sign up for any future events that you're interested in and future webinars. And of course, we exist to help advanced engineering, electronics and software companies in any way, shape or form. So if you feel there's anything we can do, or if you're interested in talking to us on how we might be able to help you, then do please get in touch. So in terms of the housekeeping for today, what we'll do is I'll hand over to Chris in a moment, who'll be presenting. I think we'll let Chris run through his presentation and talk about what he wants to talk about. But then after the presentation, we'll have a Q&A session. So please save your questions until then. But then when you do have any questions, either use the raise hand functionality via Zoom, or simply switch on your camera and give us a little wave, and then we'll revert to you. And that's basically how we're planning on doing this. We, as I mentioned just now, we're recording this session, so it will be available on our YouTube channel afterwards. Also, we'll be sharing Chris's slides and contact details with everybody afterwards as well. So if you did want to follow up with Chris or any of the Foresight team afterwards, then you'll have the opportunity to do that. So just so you're aware. I think I've run out of stuff to waffle on about, so I think I'll now hand over to Chris to start the presentation. So over to you, Chris.
Great, thanks, Pim. So I'm just going to share our slide deck, and how do we put it into F4?
Flying.
Okay, hopefully everyone can see that.
Yeah, that's perfect.
Thanks all for joining today. So we're going to be talking you through demystifying some of the funding for SMEs and some of the pitfalls along the way. So what we're going to cover today, firstly, a brief introduction to the Foresight team and Foresight itself. Then we'll talk about the broad funding landscape for SMEs before taking a deep dive into equity financing. We'll also help you understand how Foresight can help and talk you through the range of funds that we have available, and share some thoughts on the next steps to get you going. In terms of who's in the room, so I'm Chris. I've been at Foresight just coming up to 2 years. I focus specifically on our Foresight Williams Technology Fund, which I'll tell you about later on. I'm a mechanical engineer by background, started my career off at McLaren in the automotive division before moving into strategy consulting. And I've been doing about early stage investing for about 6 years now. And Hugh?
Yeah, my name's Hugh. Also work in London with Chris, although focused on different funds. I'm chiefly focused on the VCT funds and the East of England fund, which we'll talk about in further detail later. In terms of background, pretty boring, 6.5 years of investment banking. I then left to the States to do an MBA at MIT, came back, and I've been investing in UK SMEs ever since, across a range of sectors, but I've a bit of a focus on sort of engineering and manufacturing businesses.
And Ray?
Yeah, I'll kind of introduce myself. So Ray Harris. I noticed there's a few names on participants list, so a couple of you will know me already, but for those who don't, so I'm a director in our private equity team. My background started off as a kind of corporate finance advisor, then moved into early stage investing in a kind of regional fund, then back into corporate finance, and then back into early stage investing. So I don't know quite whether I'm a poacher turned gamekeeper turned poacher turned gamekeeper or something like that. Anyway, so yeah, been doing it long enough to kind of know better, I suspect. So just a quick introduction in terms of Foresight. For those who kind of don't know Foresight, Foresight's been around for quite a long time. I think it was started in 1984 in terms of the original business down in Sevenoaks in Kent. I certainly came across it as a corporate finance advisor back in the 90s. And at the time, Foresight very much had a kind of renewables focus. it's kind of developed that as well as it kind of private equity side over the last 35 years in the business. We've got a portfolio of more than 100 UK SMEs. Obviously, that kind of goes up and down as we kind of make investments and exit them. We are a very active team. So in terms of the last 12 months, we've backed more than 20 investments. We've got quite a large team, so we've got 30. They are kind of based around our regional network. So this is kind of one of the things that we think makes us interesting and as an investor. So we have our HQ in the Shard, but we also have an office in Cambridge, Milton Keynes, Leicester, Nottingham, Manchester, and Edinburgh. So, and the reason why we think that's important is that that gives us access to kind of local deals. So our kind of Milton Keynes and Leicester offices, we believe, kind of will kind of help us identify opportunities in, for instance, kind of Northamptonshire and the STC. So in terms of what we're looking to do, we're looking quite a broad range of investments. We've got a number of different funds with different profiles. So at the very earliest stage, we kind of have the Midlands engine, which I kind of look after, and the Williams, which Chris is involved in. We have some later stage stuff and some transactional funds as well, kind of going up to 10 million. So we kind of do think that we're in that kind of very early stage, but we're also kind of later stage. So we are kind of slightly different to a number of funders. Ranging from 250 to 10 million, and we have exited more than 50 companies since 2010. So we do know a little bit about exiting businesses and kind of what to do and what not to do.
Ray, I think this was you as well.
Okay. So in terms of investments, what we're kind of just trying to demonstrate here is that as an investor, we are a generalist. We do have funds that look after certainly different types of investments. Chris will kind of talk in a bit, probably towards the back end of the presentation, about the Williams Fund. The Williams Fund is a technology-driven fund, but as a result, we do tend to find that we're an industrial investor. So we're not just a software or a particular investor. We do kind of invest in lots of different things. So if you kind of look at a number of the different things that we have invested in, you will find on the list. So we've got kind of Oxford Space Systems, kind of one end of the scale in terms of antenna and items for satellites. Salvalco is one that I'm involved in, which is an airflow technology business that has an application into, of all things, deodorants. But we've got chemicals with FIS Chemicals, we've got aerospace businesses, and we've also kind of got, in terms of the portfolio, some FMCG, in terms of kind of food manufacturing, some university spin-outs. Promethean Particles is an interesting nanoparticle technology business. So we do kind of cover a wide range of stuff, but we are generally, and you know, a lot of stuff we look at is in kind of industrials, manufacturing, and actually doing things rather than just software.
So, I mean, a brief overview of the funding landscape. Hopefully, well, I won't dwell on this for too long, because hopefully it's sort of fairly well known to the individuals on the call. I guess essentially, you know, why do you need funding? And it's to fund that gap before you get to cash flow break even. And obviously, the quantum of funding that you need depends on the level of R&D and technology development, and the cost associated to enter the market. And I'm sure a lot of the people on the call today, you know, that quantum of investment can be quite material, and obviously that does tend to have a bit of an impact on the funding strategy that you might wish to consider. I think we put this slide together to help, you know, try and demonstrate the range of options available, and I think we sort of see it on a spectrum around sort of how quickly it enables you to grow. So obviously for those companies starting up, it might be bootstrapped for the first few months, which obviously avoids any dilution, but limits the speed at which you're able to grow, and usually is relatively small sums of cash. I guess there are obviously companies within the STC community who are, you know, cash flow positive, and that's investing out of retained earnings is a you know, non-dilutive way of growing. But again, you might find that either through CapEx requirements or the desire to grow faster, that might not meet the requirements of your business. A lot of our businesses do tend to seek grant funding as well. We see this as a fantastic opportunity to bring more cash into the business without that dilutive effect. One of the challenges is very often they need to be kind of match funded, either 50 or 25% match funded with private investment. So they do tend to go hand in hand with equity funding. And one of the challenges we do have is sometimes companies can be a bit guilty of chasing grants. and it often ends up sort of detracting from the core mission that they're focused on. So that's definitely something to look out for. I guess the next step up that we do see a lot of is debt investment, and it does have many merits and available from multiple sources. There are obviously some challenges around potentially personal guarantees, and it might not suit all businesses. You obviously need the cash flow to repay the debt at some point. So I guess that's why we see equity investment as a fantastic opportunity of bringing significant amounts of capital into your business without the need for a personal guarantee. And we strongly believe that equity investment doesn't just bring money, brings significant amount of experience from the investors around the table. And hopefully you've started to get a flavour for the experience that Foresight can bring. I guess there are some drawbacks. It does obviously mean that it dilutes your equity holding as founders or existing shareholders. And invariably there is some element of control which the investors will look to impart to help protect their investment and equally help see it grow. So I guess we put that in just to try and help sort of set the landscape before we then take a bit more of a dive to the equity investment. So I'll hand over to Hugh for this one.
Thanks, Chris. Yeah, I really like this chart as sort of a helpful crib for founders and anyone who's got a business that's looking to raise growth equity. Just to explain, I suppose, the sources of funding that are open to them and the processes that come with that. So if we start in the bottom left of this, and all these sources are sort of what we've called Series A, although that has a lot of different definitions these days, but a company that is perhaps pre-revenue or only generating small amounts of revenue, the options open are typically, as Chris referenced, that university R&D funding, the support of, say, an accelerator, friends and family, or perhaps angels. And at this stage, I think one of the things that makes this funding round dangerous is that the advisory community is not really involved. Institutional investors are not really involved. And so it's kind of down to the businesses, either owner or board, to kind of navigate those funding sources with the best advice that they can get, often free advice. Where Foresight sort of joins the story, I guess, is that early in growth section of the chart. That's when venture capital funds will start investing in businesses. By that stage, there's typically some commercial traction, although not always, as Chris will talk about with the Foresight Williams Fund. By this stage, the company's also raising, if not hundreds of thousands, millions of pounds of equity capital, and that allows some money to be used on fees for lawyers and corporate financiers and so on, who can help steer the company and provide welcome advice. We at Foresight can also go into that late stage section of the chart, so that label called private equity. We have a number of institutional funds, one of which, the East of England Fund, would be relevant to Silverstone, that can provide not just growth equity, but cash out to either the founders of the team or anyone who wants to realize some of the value they've created at that later stage. And that's typically once the business is generating profits of, let's say, $500,000 plus. I think one of the most helpful discussions we can have with companies, certainly early on, is why would they give away a portion of their equity in exchange for capital? I think the root answer is, look, owning a piece of a large company is much better than owning all of a small company, which will always be hard for you to exit and to grow. But some of the key symptoms for equity-specific funding, rather than perhaps debt or other forms of capital, is that the company has such a compelling opportunity in front of it. There's almost a very steep cost to not raising that capital and to not investing in the business and to not trying to capture the market and get ahead of the competition. So that's sort of what those first two bullet points are about. I would also say raising equity is bringing in a co-owner of the business, and it's really like partnering with an investor. It is very different, I think, in terms of mentality to taking a loan from a bank, where the bank's attitude is they care about getting repaid and not necessarily the growth and health of the company. So equity investors, it would be very unusual for them to be asking about personal guarantees and taking charges on assets. It's more about going on the journey with the management team, founders, and building value together. I think, yeah, the final point that we've put on there is that there are growth opportunities, maybe in the UK, they may be overseas, and it might be that the founder team just needs to broaden their expertise. And that's where investors like Foresight will not only provide capital, which is of course important, but also expertise. We're invested in 120 UK SMEs at the moment. It's very likely that whatever constraints or issues you're facing, one of our other portfolio companies is either facing them at the same time or has overcome them. And when we invest, we like to introduce non-executive directors to the board who've got that relevant experience and can help the company scale.
Great. So we put this slide together to try and help explain the differences between venture capital and private equity. I think so often the terms can be used interchangeably. And actually, something that surprised me since I've sort of been more involved in the industry is kind of almost how different they are. I mean, I think the way that we see venture capital is it tends to be the sort of first institutional equity. So the companies are at an early stage, and they do tend to still have both the technology development risk and a product market fit risk. So because there are two sources of risk, especially with kind of deep tech or engineering type businesses, there's a high chance that quite a few of them will fail. Therefore, we have to believe that each one has the potential to deliver really a very attractive returns to offset the sort of ones that don't necessarily make it. And I'll come on to that a bit more on the next slide, what that means for the types of companies we look at. Yeah, and then our private equity funds, especially, for example, the East of England fund, we tend to target, as I said, more mature, profitable businesses, ideally an EBITDA of sort of 500k to £2 million. That investment can be used for multiple purposes. It might be for growth. It might be to buy out a founder. Very common for a management team who are running a business to want to take a larger stake of ownership, to want to see more of the value that they're creating. They might not have the capital themselves to buy out existing shareholders, but they can partner with a financial sponsor such as Foresight. Foresight can provide that capital while they continue to run the business. I think something that's worth addressing is that style of investing comes with a degree of structuring designed to reward management for good performance, but also to protect an investor, especially for a minority investor, from underperformance. So if the plan goes wrong, we're investing pension fund money, we need to have, I guess, sight of a way for us to at least get our money back. So that can be slightly different from the growth equity sort of venture stage of investing, where a sponsor is very happy to sort of take that equity risk and share in the highs and lows. So I put this slide in to help explain a bit more about, when we look at the VC investments, what are we looking for? And I think the main thing to note is that VC investments don't tend to follow a normal distribution. We follow more of a sort of power law distribution. So, almost the entire fund is typically returned by 1 to 2 investments, with an acknowledgement that quite a few might not return any capital at all. And so I guess that does ultimately shape the types of investments we're looking for. And as I said, one of our main criteria is that each company has to have the potential to deliver a 10 times return. And obviously at an early stage, that can be quite hard to try and figure out which ones can and which ones can't. So some of the, I guess, features that we look for in a company that has the potential for that return, I think first one is a sort of compelling technology, which is usually in our space protected by intellectual property and patents. And that technology is serving a very large addressable market. So we're really looking for something, technologies that have the potential to sell millions, if not almost billions of units. Then we're looking for a management team that really is world-class. That is really difficult when you're looking at these sort of deep technology businesses, because you obviously need that outstanding technical performance as well as the commercial expertise. But we again, help to build management teams around them, because there's no one has the skills to do it all. Then I guess we look for sort of some evidence that that the technology is going to be sort of wanted by the market. So ideally, kind of proof of concepts, trials, some early revenues from sort of early adopter customers, to give an indication that the companies have developed something which people do want to pay for. And I think that sort of broadly covers the main points. I mean, like I say, it's looking at ability to achieve a 10 times return within 3 to 7 years. And we're also, even on the way in, thinking about who's going to be acquiring this company, why would they be acquiring it, and what's their sort of capital reserves to acquire it. So, if you're looking at a company, a US-based tech company, or IT-based company, large reserves, acquiring companies for strategic rationale, that's a sort of investment sort of profile which we believe in.
And just picking up on that point, Chris, in terms of kind of that's the sort of returns profile for really early stage venture capital investments. I think if you were looking at the private equity returns, it would probably be kind of more akin to the perceived line that you've got, in that there's a very much flatter line because you've got existing businesses which are already performing, which are already at scale, which are already kind of earning profitability. So, and again, this kind of differential between venture capital and early stage and growth investing on one hand, and later stage kind of private equity on the other. The two are very different beasts. And obviously you hope that one business is going to grow into the other, but ultimately they are kind of two different kind of investment theses early on, and people kind of need to understand which of those two they fit into when they are looking at private equity or venture capital.
Thanks, Ray.
So I guess when we compare venture capital and private equity, they're not totally different, and I think the big overlap and similarity between meeting a very early stage business or a very well-established profitable business is that for investors, it's all about backing a great team and finding a management team who are, to Chris's point, world-class, but also people you can build a rapport with and work with and have a constructive and respectful relationship with. So key management attributes we've sort of listed out on this slide. Sector expertise will typically be a given, a real passion for the business and the mentality of an owner rather than an employee. I think the ideal team often have a sort of previous track record of having founded a business, grown a business, exited a business, and kept the focus on what is best for sort of the business, but especially the owners of the business who put their capital to work. I think those teams often have a drive and speed of action, which comes from experience, conviction, pattern recognition, which means that when there are problems, they sort of run to address them, and when there are opportunities, they run to exploit them. That's sort of the ideal team. I think, as with anything in life, there are teams you meet who don't tick all of those boxes, but if the chemistry feels right, if the business looks like it's got a great opportunity in front of it, then we will often work with the teams. We undertake something called management due diligence as part of the investment process, and that can often flush out for us. Perhaps there's a gap in horsepower, perhaps there's a gap in governance, perhaps there's a gap in a certain sort of experience, maybe there's no financial director in the team at the time, and we can come up with a sort of org chart today, but also an org chart we want solved to in the opening sort of year of investment, I guess. And then on the right, we've listed out sort of other attractive attributes. If your business has these things, and again, as I say, very few businesses have all of these things immediately, but if your business has these things or is capable of achieving these things, you'll get a gaggle of investors chasing you. A growth track record, we found that as a really useful indicator of future performance. If the business is growing at a high CAGR, there's a good chance that it might not be able to maintain the same growth rate, but that growth will continue. a sustainable competitive advantage, which the team can articulate. So, you know, we're better, faster, stronger in some way. We have some novel technology or process, and that is sustainable and something that the company can rely on and will continue to generate margin. That can be, as we list out in the next bullet, something hard and obvious like IP. That can be something like a brand, which has to be protected. I think the history of protecting margin and building recurring revenue is very difficult for early stage companies, but after that sort of 5 to 10 years of commercial traction, a business should be able to point to, look, you know, there were challenges to the price. Here's how we defended our margin. You know, we needed to build up a revenue profile. Initially, we might have started with one-off sales and then reoccurring revenue, but that's now been contracted out into multi-year agreements, and we've got sort of a recurring revenue platform. Other good signals, you know, bargaining power, the ability to bargain with customers and suppliers. High customer retention is obviously a great signal for us, and not concentrating on 1 or 2 large customers, which speaks to bargaining power. Cash conversion from EBITDA to cash. There's a number of businesses who post big EBITDA numbers but have to constantly be reinvesting in other CapEx or development. Companies that have sort of scaled beyond that and are throwing off cash that can be distributed to shareholders is something that's very exciting for us. And then finally, that environment you're operating in, having that large addressable market to grow into, and having a clear regulatory environment that's unlikely to be subject to change, is something that gives investors comfort.
Okay, so I think I'm picking this slide up. So one of the things we're quite keen to do is to do a bit of perhaps jargon busting, but kind of explode some of the misconceptions around particularly private equity. So I think if you kind of look back through history, films like Pretty Woman and probably The Wolf of Wall Street have kind of given private equity investing quite a bad reputation at times. And I think that's partly because it actually misunderstands quite a lot of what's going on with the dynamics. So specifically, we kind of got some perceptions here, and the reality generally we see is quite substantially different to that. So let's kind of just rattle through a few of the kind of typical ones. So asset redistribution. The private equity firm will kind of sell off my assets of the business piece by piece until there's nothing left. So that's exactly the kind of Pretty Woman kind of example of kind of asset stripping. And typically when you kind of often sort of see a story in the press about private equity investing in something, you generally get it's the asset strippers kind of approach. It couldn't be further from the truth, to be honest. So I mean, what you tend to find is that with a private equity transaction, particularly so a later stage transaction, actually what you're doing is you're giving a kind of tax efficient value release to some of the owners, and they might be able to enjoy entrepreneurs relief at 10%, which had they be extracting their value from their own business through cash, it's kind of 40%. So there is a benefit to the owner, some respects of that, but it's far from the truth that the kind of private equity firms kind of go in, sell stuff down, and then kind of take their cash out. That isn't exactly not what happens. So second one probably is management realignment, and we've got a number of ones kind of on here about kind of management. Private equity will tell me how to run my business and I lose all control. Again, if you kind of sit down with both venture capital and kind of private equity investors, you'll find a very similar theme throughout the entire marketplace, not just Foresight. But we invest in management teams, we back management teams. And when we meet an opportunity, the most important 3 things are really management, management, and management. It's an old kind of adage. It's actually very true. So unless kind of something has gone drastically wrong, we're there to back management, not to kind of sack management. So, and we're putting our money behind them because in backing them, they will grow the value of the business to make themselves money, and in doing so make all of the investors money. So again, it couldn't be further from the truth that kind of management realignment and will happen. I mean, there is a kind of control point here, that when you get private equity investors involved in a business, they do want some element of kind of a say in things, but that's more of probably a veto rather than kind of telling you how to run your business. So when a private equity investor invests in the business, you've essentially agreed a plan, you've agreed a kind of way forward for the next 5 years. And that's a given. And it's only when you start to deviate that for sometimes kind of, good reasons, very good reasons as to why you might want to deviate from the plan. At that point, you really just need to bring the private investor along and explain why you're doing that. Now, that's kind of all it is, really. It's essentially a kind of it's a two-way thing. It's a partnership, rather than us coming and telling you how to run your business. After all, you're experts in running your business. We're not. So why would we be doing that? So in terms of other misconceptions, hit and quit. So private equity will sell me as soon as possible to realize their own gain and meet investors' requirements. Again, what you'll tend to find is that the nature of the funds that sit behind the investments will be kind of driving things. So particularly with our East of England fund, it's patient capital. The fund has an evergreen structure, and what that means is that that kind of investments go out, investments kind of get sold after kind of 5 or 6 or 7 years. The money comes back into the fund and gets reinvested again into other businesses. So there's not a time frame driving exit. The only time frame that's kind of driving exit is the one that is agreed with management kind of going in, which is subject to change at any point in the future. We all kind of know that. So depending on the kind of nature of the fund you're looking at, some have limited life of 5 or 10 years, but others are evergreen. So it's kind of not a prerequisite that kind of people are going to private equity is going to come in and try and sell things immediately. What we tend to find, certainly in the venture capital space, the earlier stage space, it takes a long time to build value in a business. So I think Chris talked about kind of 3 to 7 year time horizon. The reason that time horizon is in there is it does take that long to build the value that we all kind of see as the kind of future opportunity or future potential of the business. These are very rarely kind of in and out in 1, 2, 3, 4 years. So in terms of kind of other ones, I'll just kind of rattle through a couple more. So employment rationalization, the investment will be closely followed by dismissal of management and staff. Again, very few opportunities, other than perhaps there might be occasional one in the press where a business is underperforming, but this is growth capital that we're talking about. This is quite the opposite. So you'll tend to find that when private equity goes in, it's because there's a growth profile behind the business. So actually there isn't fat to trim. And actually, you'll tend to find that those businesses that are private equity backed create far more jobs than other businesses around them, which is why it's called growth investment. So again, it actually couldn't be further from the truth, even though you might see in the press, an underperforming business kind of gets taken over and kind of costs get cut. That is very rarely the market in which we live. So we're growth investing. It's all about growth, and it's much more likely to create kind of jobs. And then the last one I'll kind of touch on is leverage optimization. So this is kind of getting debt into a transaction to try and improve the returns of the investor. Now, again, with venture capital, you will very rarely see debt as part of a structure, because with early stage businesses, they don't have the ability to repay that debt, nor would any funder who's a debt funder actually provide that to you. You're just too early. So you don't see those in early stage transactions. You will see it partly in later stage transactions. So where a management buyout is taking place, or whether East of England might be kind of buying a stake of a business, buying a 40% stake. At that point, you might see an element of debt as part of the package. But actually, if you kind of look at the stats, the average debt across the portfolio in doing those types of transactions is just a little bit over 1 times the profit or the cash generation, the EBITDA of the business. So it's at generally low levels, and it's at levels that, frankly, an investor, an owner of a business can actually probably get themselves if they were looking to kind of expand. So it's levels that are comfortable. And it's not something that we typically tend to put into any of our transactions because over leverage generally only ends in pain. So that's not the way we work. So what you need is an affordable structure that kind of provides that balance between debt and equity to get you the most optimal use of capital.
Thanks, Ray. I think just conscious of time a bit, so I might skip through this one and go on to talk a little bit about some of the funds that Foresight has to offer. So I've alluded a little bit to the Foresight Williams Technology Fund. This is actually a partnership between Foresight Group and Williams Advanced Engineering, which is the engineering consultancy that spun out of the F1 Group back in 2010. This is a EIS and VCT fund, so we're investing private individuals' money. It's a retail fund. We're coming up towards 70 million of funds under management. And what we're looking for is, as I sort of said, those companies which have the potential for oversized returns with an outstanding sort of world-class technology backed up by IP, with a really top team, management team as well. We typically invest between about $500,000 to $2 million in an initial round. That's often alongside some other investors, so usual round sizes of kind of 2 to 5 million or so. And we then prepare to follow on. So we expect to make subsequent investments, adding up to sort of £7 more million in future rounds. To give you a bit of a feeling for some of the types of investments that we've done recently, one of our companies called AMT is plays in the 3D printing space, but focuses specifically on post-processing, which I think accounts for about 30% of the cost of a component. So these guys have developed a series of machines which help to automate those processes, thus helping to reduce the cost of components. Audio Scenic is one of mine. They're a Southampton University-based company which is developing a 3D audio technology using loudspeakers. So sort of Dolby Atmos is a recent format which creates a much more immersive 3D sound, but at the minute it can only be experienced really using headphones. These guys have a dynamic loudspeaker array which uses head tracking technology. Vector Photonics is a recent Glasgow-based company developing a semiconductor laser which has exciting applications in data center data transfer. And our most recent investment, which was announced, is a company called VividQ, a Cambridge-based company developing developing software to enable holographic displays. So they're able to speed up reduce the processing power required to create a holographic image by a factor of 1,000, which has potential to put holographic displays into devices like head-up displays in cars, display screens, and even potentially smart glasses. So that's a huge market opportunity, very exciting technology, which we're really pleased to be part of that one. So that provides a bit more about sort of the portfolio. In terms of all of our companies, when we make the investment with Williams, it's a very close partnership, and all of our portfolio companies have access to the full sort of range of WAE value add, and we see that as sort of credibility, expertise, and the network. So we certainly find that companies that take investment from us tend to find it easier to go and secure commercial contracts, especially when the potential customers found out that Williams has run the slide rule over the technology to the point that we're willing to invest money in it. That's certainly a huge source of value add. The expertise, so Williams has a network of, a team of over 250 engineers with a wide range of skills, some of which you can see there. And we've got some great examples of companies which have lent on these skills to either, one had a new case design for scientific instruments in a very short period of time to allow them to release the product at a trade show. Another one used computational fluid dynamics to optimize the design of a hot water tank. So lots of examples of where they've dived into the experience within WAE to help accelerate the commercial or technical progress. And then finally, the network. WAE has a huge network of sort of blue chips and SMEs in multiple sectors outside of automotive. So aerospace and defense, the sports industry and leisure industry, and many others. And increasingly, we're finding that WAE knows someone who could be really helpful to the companies, and that's making those networks and connections is something which we also try really hard to do. So hopefully that provides a bit more of an insight about the Foresight Williams Fund, and I'm obviously very happy to answer any questions that people have on that. And then Hugh, I'll hand you over for the East of England Fund.
Yeah, appreciate a number of people on the call have sort of heard me speak about this before. But a couple of years ago, we raised our East of England Fund, a £100 million evergreen fund, taking capital from local pension funds and investing it in local businesses. The definition of the East of England is Norfolk, Suffolk, Cambridgeshire and Northamptonshire, so just about capture Silverstone, but we will invest in sort of a wider region also. I think of the points that we've made already, we're looking for established companies. We can provide both growth and cash out. That's made on the slide, but what's key for me is that third bullet point of a tailored approach. I think there's a lot of low and mid-market private equity funds who will come out with a relatively cookie cutter solution to any transaction, and they will try and put square or circle pegs through their triangular hole. We try and take a genuine tailored approach. We have a team based in Cambridge. We also have dedicated resources in the London office. We will take our time to get to know the management team, to get to know the vendors, to understand what people are trying to achieve, and to tailor any solution to sort of meet those needs. I would also say we're very conscious that we're obviously committed to the region. We've got the office in Cambridge. We've got an evergreen fund. We're going to be a part of the investing landscape for the long term. And so we're focused on our reputation for deliverability, making fair offers and then standing by them and delivering.
Yeah, I'm just going to pick up one of the regional funds. So Midlands Engine Investment Fund. I think we've actually kind of come down and did one of our launch events at STC back in 2018. So this is an earlier stage fund. We've kind of talked about Foresight having a range of funds. Hugh's just kind of talked about the kind of private equity in the East of England fund. Chris and I are kind of sitting in the earlier stage funds. So this is very much the kind of growth capital part of the business. Midlands Engine is an East Midlands focused fund, essentially kind of doing investments between 250,000 and 2 million. It's deliberately focused at businesses in the early stage of their life. So we have a number of rules that we kind of have to satisfy. You have to be an SME. Pretty much all of the businesses we see are that, but you have to be kind of within the first 7 years of your commercial revenue. And to be honest, outside of that, we tend to see that most businesses, most early stage growth businesses, will kind of fit the rules of the Midlands Engine Fund. So in very simple terms, it's an early stage fund, 250 to 2 million into East Midlands businesses. It's a generalist investor as well. I mean, typically what we tend to see is that the businesses are doing perhaps 100k turnover annually at the bottom end, and probably no more than $1 million or $2 million at the top end, to give you a kind of rough idea of the scale of businesses that we're looking at.
And finally, just to update you on, I guess, what is our flagship funds, our VCT funds. It's what Foresight's been managing for sort of 30 plus years. We have about 230 million of capital that we look to invest in early stage, high growth companies. There's certain qualification hurdles that companies have to meet. I'm sure at the STC, most companies would be comfortably under 250 employees. The money must be used for growth or entrance into new markets, but it's a nationwide fund, so more flexible than the regional funds, and it's very focused on sort of value creation in that journey. When we talked about way back at the beginning of this presentation, that slide on early stage, it's that growth equity investment where we're looking to grow businesses, partner with management teams, go on the journey with them together. I think the next slide, we've got a case study of a deal I worked on, which completed in August, £4.8 million growth equity check into Callan Lenz Associates, which is based near Salisbury. A UAV or UAS business, really interesting business model of doing everything from the initial R&D work through to sort of commercializing the technologies that come out of that, both hardware and software. So we wrote that check. We've taken a minority stake. We're working with the board to appoint a non-executive director who we hope will bring industry contacts, but also experience in terms of governance and sort of scaling the business. There's no plans to change the management team. The founder CEO remains founder CEO. There was an FD in place when we invested who we've built a good relationship with, so no changes there. What made this business VCT qualifying? It was over 7 years old, but they'd taken some EIS money earlier in the journey, so that's perhaps something we could talk about later, how taking EIS money at an early round, even if it's sort of £10,000, can open up access to these VCT funds later in the company's life. And the investment thesis is very much continuing to execute on the strategy that the company already had in place. So building relationships with the 10 large enterprise customers they have today, and adding more, I guess, private sector customers, and continuing to prove the ability to build initial relationships with R&D work, but then deepen those relationships with the sale of hardware, which can be recurring revenue, and software, which is obviously recurring revenue.
Thanks, Hugh. And I think, Ray, you were going to just run through some of the next steps.
Yeah, so I guess there'll be a number of people kind of sitting around, hopefully with a little bit more of an understanding of kind of the murky world of venture capital and private equity, and kind of, kind of what different funds are looking for. Clearly, we're kind of here to answer some questions, and I think we've probably got a Q&A session if anybody's got any questions. But when you're kind of thinking about what you should do and whether you should take private equity, I think that there's a number of things that you can do before you kind of contact any private equity provider. So first and foremost, kind of think about your growth plan, think about what you want to achieve, what your targets are going to be. You also kind of need to kind of put that into context and work out what you think the investment size is. So we do see a number of businesses who've got a great investment thesis and actually haven't thought about how much money they need to deliver that, and kind of whether that be kind of working capital or kind of growing their sales and marketing functions or whatever. So do put some time into that. If necessary, get a corporate finance advisor or an accountant to kind of help you pull your thoughts together, potentially in a model or a cash flow model or something along those lines that will help you articulate kind of how the costs are going to scale, how the revenues are going to scale, and kind of where you can identify and benefit from kind of the opportunities and risks, and also kind of particularly how you mitigate those. So particularly if you've got an idea of how your business is going to grow, and you pull together a financing model which explains kind of what cash is going to be needed. Perhaps also talk about sort of what if scenarios. What if sales don't come through as quickly as I think? What levers can I pull? Can I kind of delay some of the costs? Can I make my money last a bit longer until I get those proof points that will allow me to get potentially another funding round or get to profitability? So think about kind of all of those things before you kind of sit down with your private equity firm, but engage advisors as well at that point, because they can help. They are really useful in terms of as a sounding board. They will help you kind of pull a lot of these things together, whether it be an information memorandum, a deck, or a model. So, and that just makes you look much more professional when you sit in front of your kind of private equity provider. So that gives us the kind of comfort that you've taken the time to think about all of those things. At that point, by all means, kind of pick up the phone to Chris at Foresight, and we've got some kind of contact details later, or myself and Hugh. The whole point of private equity will help you shape that proposition. So even if you kind of come to us and we go, actually, it's 90% right, and actually, if we change 10%, we kind of talk to you about kind of how it needs to change to kind of get it to 100% in terms of where we kind of need it to be. But we will help you through that process. As also kind of take care of the housekeeping. So if there are issues identified, or you've got some issues that are sitting in the back of the business, deal with them kind of before you sort of sit down with a private investor. So, or at least demonstrate that you're articulating what it is that your strategy is and how you're going to deal with it. So the worst thing that can happen is you go through due diligence and you find a skeleton in the closet that either hasn't been identified, or you're just kind of trying to, not get away, but essentially not deal with, or sort of trying to deal with it in a way that's kind of suboptimal. So let's address those issues. Let's address them together. Let's be open about kind of what they are, and you will generally tend to find that the investor will help you shape those. And then do allow yourself enough time just to kind of get all of those things done, because things do take time. So, and last one, again, it's kind of related to the advisors, but having a lawyer on early, particularly if there's a kind of complicated shareholding structure, will help. It's kind of just kind of makes things kind of a little bit easier, a little bit kind of tidier for your investor, which kind of gives them a good glowing feeling that you're on top of things.
Thanks, Ray. So I think you sort of last slide really was just to share our contact details with you. As Ray said, we're very happy to sort of take any calls or emails that you have and discuss anything further. And I guess really it was sort of, opening up for 10 minutes of questions, if anyone has any.
Excellent. Thank you all very much. Very, very, very interesting stuff. Before we kick off with the questions, I thought it was a very strong note to end on with kind of like the support and the things that you need to look at and the things that you need to consider and stuff. What I would actually add to that, which I suppose is a little bit of a shameless plug, but then it is free of charge, so I think I can get away with it, is we, with our partner, so we're Trailblazer partners for Be the Business, and via then we do actually offer mentoring service as well, so you can get a 12-month mentorship. And it may be, if you're considering going down this particular route, but you're very much at the start of the journey, it may well be a good idea to engage with the membership and get somebody in who's gone through it before, so they can help you build up to it, because it's not going to be as simple as just ringing up Chris and go, hey man, you want to buy a company? There's a lot more that needs to happen before that. And a mentorship could well help with that. So maybe something to consider, especially as we operate.
And Pim, we do see that a lot, and actually that's really valuable. So, and you tend to find that kind of angel investors or kind of non-execs really do help shape an early stage business. So it's something that we're really supportive of, really keen to sort of see happen. So
so please do consider that. I mean, obviously, we'll now move on to the question part. So if anybody does have, Chris, I'll stop the sharing. So obviously, if there are any questions, please raise your hand. Robert, Rob, over to you.
You knew I'd be at the front of the queue, didn't you?
I suspected as much, yes.
Yeah, thank you for that presentation, chaps. I have spoken to one or two of your colleagues, and I will be in touch with you. My question is, who invests typically in your funds?
So that's a good question. Different people, isn't it?
Yeah, I can speak.
I'm guessing that it's probably the Pareto curve, but is it mainly big institutional funds, pension funds, or do you get a mixture of? Does the tail end of it comprise individual investors? Give us a feel for the typical investor into your funds.
So I mean, within the EIS and VCT funds, they do tend to be private individuals who's probably sought some kind of tax mitigation advice, and an EIS and VCT product has been sort of the one recommended for them. But then moving towards some of the other funds, so I mean, Hugh, the East of England fund is a bit different, isn't it?
Yeah, so for the Williams fund and the VCTs, they're sort of these listed funds or retail funds where it's individual investors. For the East of England fund, it's very much an institutional fund, so it's a local pension fund investing the pensions of local people, but ultimately an institution. And they want their capital deployed into local businesses, and so that's what we're doing.
Yeah.
And then Ray can talk about the Midlands.
Yeah, so Midlands Engine is different again. So Midlands Engine is British Business Bank backed, so it kind of has an agenda of driving equity out into the regions. So it's European Regional Development Fund money, European Investment Bank money. So again, depending on the nature of the fund, you tend to get a different type of investor, but that also then shapes what the types of opportunities that are looking for because of the different returns or kind of that they're looking for. So a pension fund might be looking for a different returns profile to an early stage investor who's kind of looking for growth in the region.
Thanks, Ray. And just a final one from me. How many funds do you have under management currently?
Is that within Foresight Group or the sort of private equity division? So
within the whole group, yeah.
It's about, I think it's just on about 7.5 billion now. 90% of that is sort of in the renewable infrastructure side of the business, and so we're about 750 million within the private equity fund.
And that's spread across how many funds?
I mean,
7, is it? So we've got our
seven
funds, our Williams fund, our Midlands Engine, our Nottingham focused fund, our Scotland focused fund, and then 2 in the Northwest. Yeah, 7.
Thanks.
Plus a fund we can access for Northern Ireland, actually.
Excellent.
I mean, a quick question in terms of kind of Robert, if what we tend tend to say to people is, come and talk to us. We'll tell you which of the funds has the profile that fits best with kind of what you're looking for, because it can be very kind of confusing, certainly when you've got funds with different kind of profiles and different objectives. But Chris will kind of know which is the best fund for any particular opportunity, and he has a whole team of us of 30 that we can kind of talk to and toss it around.
Yeah, excellent. Thanks for that, guys. As I said, I'll be reaching out to you anyway.
Right. Sandy, you switched on your camera. Is that because you want to ask a question, or are you just want to participate? Just checking.
Yes, thank you. Thank you.
Over to you.
I was just wondering how you pick sectors, because you have explained how generalistic you are on, okay, you have your criteria, financial criteria. I was wondering how you pick a sector and how you map it out.
Was that sort of specifically relating to one of the funds? So within the Williams?
No, in general, as a global PE fund, what sort of sectors do you go for?
I mean, I guess I can speak for more of the sort of the technology funds. I think we're sort of sector agnostic, but we're then looking at those sectors which have attractive dynamics. So either sort of very high growth rates, Hugh alluded to it earlier, with kind of stable regulatory environments that aren't going to massively change. We do look at kind of the industry players, both from a level of, the competitive environment, how hard is it to try and get ahead in that sector, and also, who's the potential acquirers for that. And then I can't remember if I've said it already, but just that kind of, the overall market size, and really thinking about the sort of the value pool. That there are some sectors where it's always a race to the bottom, and you're lucky if you return just above your cost of capital.
Yes.
We're trying to find those opportunities where there's almost perhaps some sort of market imbalance, which allows you to go and sort of achieve a sort of super normal profit, really. That's what kind of how we think of it. I mean,
I think for example, for the VCTs, but it really applies to every fund. You would have seen in the presentation, we're writing tickets sometimes as low as 250k, sometimes 10 million, but they often end up at 750k to 3 million is probably our sort of sweet spot typically.
Yeah.
We're not investing in enormous companies. We're investing in relatively small companies that are going to grow. We're therefore fundamentally looking for businesses with a sustainable competitive advantage, and we need to understand what that is. We can find that in all sorts of sectors, but if you then apply a top-down look at the 120 companies we are invested in, I would say a third of those end up being tech companies. And then the next two largest groups of companies would be tech-enabled business services and tech-enabled or IP-rich manufacturing businesses or engineering businesses. So you end up drawn into those sectors because they tend to be hubs of innovation where you can find companies with a defendable competitive advantage and an addressable market that they can grow into.
Yeah, makes sense. Okay, thank you.
And I think, we also have, Foresight does have a strong ESG, so environmental, social and governance perspective. So there are then obviously sectors that, to help meet the UN Sustainable Development Goals, we should probably try and avoid investing into as well. So that does also shape our investment criteria.
Yeah, I must say I was very touched about that, because I don't know many PE houses who do have such an ethic as a ESG on contributing to companies who make the world a better place. And I must say I found it rare enough. So it must be a differentiation when people pick you.
And I think it cuts both ways as well. Equally from the investors looking to invest in Foresight, I think they appreciate that. But I think also increasingly management teams appreciate an investor who's coming on, who thinks about more than just the single bottom lines, whether it's that triple bottom line approach, but viewing success of the company in perhaps slightly more of a holistic view. Yeah. We certainly find that tends to differentiate ourselves in the market, and is something which is well received by management teams.
Yeah, I agree, and it caught my attention because I hadn't heard from Foresight until Monday. I must say it did catch my attention. Yeah, so
great.
Yeah.
Excellent, thank you. I'm kind of conscious on time. Is there anybody else who has any other questions or anything they want to contribute? Please speak up now. I'll ask a quick question, potentially a final one. Obviously we've had the weirdest 18 past months of most people's lives, I should imagine. How has that sort of affected thing in terms of, you know, your investors and what you're looking for? Is it more busy now? Is it less busy? Has activity gone up, down? How has COVID affected things? Could we comment on that maybe?
I think it's probably not what we'd expected. I mean, fortunately, as a portfolio, I think we're pretty confident to say that none of our businesses actually went under during COVID. Actually, everyone survived remarkably well, both through a combination of the advice and support we gave them during that period, and obviously also the government funds available. There does seem to be an even greater influx of capital into the private markets, I guess partly helped by the likes of quantitative easing and that money making its way through to the financial sector. So, you know, we do feel that we are in quite a bubble at the minute. There does seem to be a lot of capital out there which is looking to be deployed. That does have an impact on valuations to a certain extent. There's also then a lot of companies seeing, you know, the huge growth potential out there, and so are, you know, wanting to go and capture that with both hands. So I think, you know, there's both supply of capital and demand has grown. I think there's probably also another dynamic which is we're increasingly starting to see is that inflationary pressure. So certainly, again, within the Williams Technology Fund, availability of the really top quality technical skills, you know, AI, machine learning, advanced engineering, those skills are rare, and Brexit hasn't helped. And so salaries are going up. And so this is a bit of a sort of virtuous circle. So, you know, people are needing to raise more and are spending it. So who knows where it will take us, but actually it's been all guns blazing really the last 12 months, and hopefully it will continue.
Excellent.
Yeah, and I think our investment appetite is kind of unbridled, isn't it? We're continuing to invest kind of, you know, throughout the cycle, whatever that cycle may look like.
Yeah.
Excellent. Very good. Right. It's a couple of minutes past 12, so I think we'll bring proceedings to a close. But thank you very much. It's been very interesting. So Chris, you, Ray, thank you very much. Obviously, thank you for participating. Now, what we normally do is I run a little poll to get your feedback, obviously on this webinar, but also importantly to tell us what you would like to hear about next. So if you could take a couple of minutes just to fill that in. I think when we test it, it takes about 40 seconds. So hopefully that's something that you can spare. So while everybody in the room is doing that, I'll finish the recording. So I'd just like to say thank you to the audience that's been watching this on YouTube. Please like, share and subscribe our channel. I always hear people on YouTube saying that, so it must be good for something. So please have a go at doing that. But thank you very much for watching. Obviously, please check out some of the other videos, and do please visit our website to look at any future events that you might want to attend. And hopefully we'll see you at one of them soon. So thank you very much for watching.